Good evening, ladies and gentlemen. Welcome to our webinar on the trading plan. Tonight's webinar is sponsored by investing.com and X90, one of the leading platform providers in the world. And if you aren't trading or you're looking to make a change, X90 is one of the best places to start trading with. You can trade stocks, commodities, currencies, Forex, CFDs with X90. You can use either their downloadable platform, their MT4, or you can use their online platform. They have one of the most advanced trading systems out there. You can trade shares, indices, commodities, and Forex through their CFD platform. You can open up a free demo trading account. You get real live market data. You get trading trends. You get all kinds of access. And you also have easy access to stock exchanges around the world. They have a huge array of stocks and indices that you can trade. You also get excellent trading bonuses and no commissions with the best platform you can get. You can open your account for as little as 100 euros and start trading CFDs on stocks, Forex, indices, oil, and more. You can fund your account with credit cards, PayPal, Skrill, wire transfers, whatever which way you wish to use, and you can get up to 500 to 1 leverage depending on where your home country is and who the regulator is there, because we always follow whatever laws are required by the regulator in your home country. So tonight we're going to be talking about building a trading plan. It is one of the most crucial things you can do. And unfortunately, too many people, especially newbie traders, are lazy. They just want to get on an online trading platform and start making trades. I've been trading for 40 years, and I get my enjoyment out of making my trading decision, about doing my research and building my trade. And all this fits into what you call your trading plan. And it's very important, because not only do you build them, you make them. If you come to my office, you'll see them glued to all my walls. Every trade that I have going on at the moment has a plan. And yes, I use computers for everything, but I like printed data. So I print out my plan. And your plan can be as small or as large as you wish. You'll find the longer you trade, the more data, the more steps you use in making your trading. And trading plans, though, are not strategies. Trading plans aren't I'm going to use Bollinger Bands and RSI, and when they cross over, I'm going to enter a trade. That's your strategy. That's not your trading plan. In order to become a successful trader, you need to develop a written trading plan. Okay. This is where you put your rules that you follow. This is where you put your risk management. This is where you put down how much you'll invest in a trade, how long you will let that trade ride. Okay. And each trade is different. But if you say, okay, I'm going to enter the euro US dollar today and I'm going to close it, okay, because I think it's going to go up by tomorrow afternoon, this is when you exit that trade and you build that in your trading plan. Open at 9 a.m. on Thursday, close by 12 noon on Friday. And these are your laws, your rules that you live by. If your rule is you have to have a 3-to-1 profit to loss ratio, this is what your rule is, and then you do your calculations right there on your trading plan, because then you decide, okay, I may be completely right, but the risk is too low for the reward in this trade, so therefore I'm not going to make it because your rules said you're using a 3-to-1 trading ratio. Or maybe you're sure that the assets can go up, okay? And you say, I'm going to get cocky today. I'm going to risk $1,000 on my whole $1,200. But your trading plan says you can only risk no more than 10% of your portfolio. Okay, it keeps you in line. So basically, your trading plan is your trading Bible. There is no such thing as the ultimate trading plan, because there are no two exact same traders. Now, whenever I do this class, people ask me, can you give us an example of a trading plan? So I put 2 of them into your handouts. And You can start with them, but a trading plan is something that is very, very personal. It's based on your experience, your knowledge. It's based on what strategy, not what strategy, because there is an area where you incorporate your strategy. Because again, I'm old-fashioned, so I have boxes and paper, because I keep track of every trade, I keep track of every strategy, because when I see something happen in the market, I can say, you know what, I saw this kind of something like this happening last year. And I can pull out that strategy I used last year that worked really well because I have strategies over here, which is a combination of elements. Okay. And I pull it out and say, you know, because after a trade is over and I see my strategy didn't work, you know, last year, I incorporated this, and this, and I made this trade, but it didn't do as well as I thought, or maybe it ended up being a losing trade. I've got that's highlighted with red magic marker around the edge. So I know that's a bad strategy. When I go looking for it, I say, that one doesn't work well. That gets dropped into your trading plan. It's just one of those things. So imagine, as most of you know, I'm American. I'm not in the States, but I was born and raised and went to university in the States. And when you go to a car dealer to buy a car, okay, you go in and most people don't order cars. They buy what's on the showroom floor. But when you look at the invoice on the side of the car, it's got a million add-ons. It's got your wheels. It's got your tires. It's got the interior. It's got the right side mirror, the left side mirror. It's got listed, whether you want power mirrors, whether you want power windows, whether you want this special radio, whether you have this GPS. But the crucial part is when you're buying a Mustang, it's still a Mustang. It's still a Ford. Well, that's what it is. Your trading plan is still Ford, okay? Then you have your Mustang. Then you have all the crucial pieces that make up it. Some of those can be left off. Some of them may not be incorporated in everything, but they are crucial to have. And your trading plan makes sure that you don't miss elements. Okay, a trading plan should be thought of as a template for trading the markets. Perhaps an even better way to describe a trading plan is that it's a checklist. This checklist will contain each aspect of making a trade in a logical step-by-step sequence that acts as your objective guide in trading the market. It also helps funnel your trade. As you're filling off your checklist or filling in your trading plan, it may end up telling you, don't make this trade, because it may not fit all the requirements you have. Okay, so it will help you from making mistakes. It will help point out errors. It'll help you from not getting too much. Maybe the markets are too volatile, and it's saying, okay, if this asset moved this far in the last hour, you don't want to trade it because it's too volatile. Okay, so you can include in there volume. You can include in there the market volatility, how far that asset moved, how many points it moved over the last 2 hours. Some of us trade at specific times in a day. I know a guy who only traded gold at specific hours between the overlap, the Asian and the European markets. Okay. And this was part of his Bible. Okay. That was the only time a day. Maybe smart people or some people who are too much compulsive traders, their trading plan only allows them to trade on Monday, Wednesday, and Friday. Tuesday and Thursday, they do market evaluation only, because some people want to get too many trades. I know people that have 8 and 10 and 15 trades going at one time. They come home from work, they get on the computer, and they spend the next 8 hours opening and closing trades. I spend more than that evaluating a trade before I make it. But if you start building your trading plan, maybe you're only allowed to have 3 active trades open. Maybe your trading plan says you can only make 1 trade a day, so when you see all of them, you decide which one will be the trade you can make, because this is part of your plan. But in essence, it is your plan. A trading plan will state your overall short and long-term goals as a trader and provide you with a clearer checklist of how to achieve them. What strategy you're going to trade, what currency pairs you're going to trade, and what your daily routine will be. In order to build your own trading plan, you should put in it all of these things. So the question is, where do I start? And this is the element that gets a lot of traders lost. They don't want to start anything. They want me, or they want to find somebody to hand them a plan. But there is no such thing. You need to start out on your own. Okay. Not start out with your strategies, because everybody wants to jump in there. You're going to say, I went to a class on Bollinger Bands. I'm going to start trading Bollinger Bands tonight. Okay. You should begin your trading plan with your strategies. If you build an entire strategy, and build it, and maybe you say part of your trading plan is, I will only use a strategy that I've tested for 30 days in a demo account, and once it was successful in 30 days and it made more profits than losses, I will then incorporate that and start using it in this trading plan. So if you're trading price action setups or off key structure levels or structured trading or advanced patterns, then you should put them in first. This will act as a blueprint for what you need to do each time you interact with the markets. You firstly need to backtest all your strategies in order to find out whether they have positive expectancy, simply put, making money or not. Because, the other thing is a strategy wears out in time. Markets change, and a strategy that was working last week may not work in this week's market. So you need to look, when did I test this last? Well, maybe I haven't traded in a couple of weeks. Maybe I need to do 2 test trades, demo trades, or paper trades on this before I'm going to use it today. Okay. All of this is written in your plan. And, this is the funny part. It is involved. Okay. And it should constantly grow. Okay. Now, having written strategies with your risk tolerance and money management is like having a market blueprint. This blueprint is essential in developing the discipline that it will lead you to the road to success. If you find yourself not following the rules in your trading plan, then you know you are deviating from your plan. So the next thing it should state is what instrument you are trading. Now, this is a problem I find with retail investing, because retail investing opens up all these assets to you. Now, I traded as a professional trader, back in the pits, way, way long ago in 82, 83, and 84. But I only traded commodities, but I only traded agriculturals. Okay. And I was a specialist in only a couple commodities. Today, I talk to people, well, I traded Apple yesterday. I did really well. I made a couple bucks. But then today I'm trading the dollar and I didn't do so good. And tomorrow, whenever I traded gold. They're all over the place. You can only be an expert in a couple things. So to keep you in the right lane is decide what instruments you will be trading. Now, this isn't saying you can't trade them all, but maybe on Mondays you'll look at currencies. On Wednesdays you'll trade stocks. But, you can't be all over the place. You can't track and watch all of those assets. You can't make determination. You won't get to know the personality. And if you spend hours and hours testing your strategy and your analysis, building your trading plan, you won't have time to look at all of that many assets. So it's very important that maybe you should say, or even if you're looking at just currencies, that maybe you're going to become an expert in the Euro GBP and maybe the pound dollar and the US dollar. Or maybe you want to trade the Japanese yen, or whenever you trade the pound US dollar, you'll back it off with a pound, Euro pound trade. Okay. This is part of your trading plan. And too many traders don't want to be restricted. But you can't trade successfully and trade the Dow one day, the FTSE the next day, trade Apple stock the next day, and trade silver and platinum and oil the following day. You need to have a routine in your trading activities. In your pre-market phase, you will write all you are going to do from waking up to what you do before you sit at your trading desktop. And since none of us are full-time traders, most of us have jobs, and we don't trade 24/7. We're not professional traders, or we're not trading, big accounts. We're trading in our spare time, so to speak. Maybe your checklist should say on Wednesdays, I don't trade at all. Everybody needs a break from the market. People who run home every night from work and go online and trade before the American markets open, or trading all night every night, are getting burnt out. So A lot of this is very important. What are your steps? Because your trading plan incorporates you, your life. You'd be surprised how important that becomes. You know, okay, my trading plans, when I wake up in the morning, what do? And I have certain routines. This, after my coffee in the morning, my computers are booted. I look at the charts real quickly overnight. I look at today's economics calendar, and I look at the news headlines. After that, I've already formulated a story of what's going to go on with all of my assets. That takes me 15 minutes, a half hour. By then, I got off to have my breakfast, my shower, whatever else. Then I come back to do my serious work. But this is my plan. I've digested the market. I mean, I have processes and steps. And this can incorporate when you have your lunch hour at work. What am I going to do quickly to look at so I can monitor what's going on? And you think this is crazy. You think this is invasive. But you'll find that it isn't. It will keep you in a routine and keep you from making emotional mistakes. Now, during your trading phase, you would follow your checklist. This is crucial in order to put yourself in high probability trading opportunities. This will include things like looking for in the market what you want to see before entering your trade. If you're post-market phase, your main activity will be to record keeping your trades. And this is the other part that too many traders don't do. I was telling you just before, I have all of my trading strategies, and I have, I've got red magic marker around the ones that failed. I have green magic markers around the edges of ones that were good. I have yellow magic markers on ones that I'm a little cautious. And I have other highlighters, and I have sticky notes all over everything. Okay? Because every trade you do should be analyzed after it is over. Okay? And whether you put it in a trading journal, whether you put it online in a diary, whether you put it in a box, but you have to be able to access these easily. So if you stop to think that part of your trading activity is your record keeping, okay, and think of this as part of your trading plan, that within hours of this trade being over, I'm going to write up my analysis, and today with computers and all the stuff we have, you can keep all your files. I'm an old guy, so back when I started trading, we didn't really have computers. We didn't have PCs anyway, okay. And so everything was done by hand. So I developed by these hands. Now everything is mostly on my computer anyway, but I still have my index cards, my sticky notes, and everything else. But today you can build everything in Excel spreadsheets and workbooks and everything else. Because it's very easy to have your trading plan, and you have them filed over to good, successful. Which ones are good. You can have them filed under. You can have multiple filed. Under which assets they work well. Because maybe you have a strategy that works very, very good for the euro pound, but it doesn't work so good for the USD JPY. So you got to file it under the euro pound. So when when you see something happen to the euro pound, you just open up your folder on your computer of what strategy you work. Find the one that you think is successful in this current market, and you can have folders for volatile markets, for non-volatile. You decide how you want. But this is what is the time-consuming. And if you can find this of being interest to yourself and making it part of your trade, because when I do all this, the more effort I put into it, and that trade is successful, I don't care how much money I made. I care that I made a successful trade. So if you imagine a football team that reads a play and spends hours and hours mastering it, practicing it, scrimmages, and then finally comes game day on Sunday and they actually execute it, that's their reward for all of that practice. But after the game is over, don't you think they're in the locker room with the coach watching all the televised version and analyzing every play that they made? And okay, we made this play, it was successful, we got a touchdown, but maybe we could have executed a little bit, and they're analyzing it continuously. And all those plays end up in their playbooks. And this is what the enjoyment should come from. So make sure you maintain a trading journal which logs all of your trades. This is important because it allows you to analyze your trades and the success of the plan you adopted. Okay. It should include entry date, entry price, exit price, stop, limit, total profit and loss, final notes, which are your personal notes on each trade. Okay. Now, again, you're saying something, do I really want to invest this time? Well, if you want to trade and make money, you got to put the effort into it. Okay. Now, your daily routines are crucial for your trading success because based on them, we will build a ritual that help us maintain a high level of focus and a state where we perform at our best level. All top athletes and sportsmen go through their own ritual in order to perform at their best. Whether you're a weekend jogger, you don't just get out and go running, without doing your warm-ups. And if you're getting ready for a marathon, 2 months from now, you're increasing your workouts each day. You're building your stamina, and you're making sure your muscle relax. So you're going through your workouts, your prep. None of this comes easy. The ultimate end is your enjoyment of your success. Okay. Now, I see all the people that have losing trades, but then I see all the ones who lost their money. If you have a losing trade and you're going through all this, losing trades are not bad things. So losing trades are learning experiences, and they help you define your trading plan. And if you're using the right money management, risk management, so what? Everybody knows they're going to have 5 losing trades out of at least every 10 trades. The whole idea is that of those 5 winning trades, you made enough money to cover your losses and make some profit. But if you didn't follow your trading plan and didn't have your risk management, money management built into it, you probably didn't. So stick-to-itness is the word. Is it really a word? Yeah, it's a word. The creation of a trading plan is highly useful as it reduces the possibility of bad or irrational decisions based on emotion. If you have a written trading plan, then you have a trading filter that will filter only high probability trading opportunities. It is important to have a written plan because in order to keep a high level of discipline, you should read it every day. The key to discipline and objective forex trading is to establish a trading plan where you put all your necessary rules and stick to it. Okay. Now, we're going to look at the 10 elements of a winning trading plan. So if you ask 100 traders if they can send you a copy of their trading plan, I guarantee you it will be the highest rejection event of your life. Traders don't want to make, unfortunately, too many don't want to make the time and effort. In my classes that I teach a set of beginning technical analysis. And this is a 4-week class. And when the attendees come, the first thing I ask them to do is to pick one asset. I don't care what it is because they're not going to be trading it. Pick one asset that you have some attraction to and pick that chart, and you'll be using that asset over the next 4 weeks to do your analysis. And you'll be getting to know the personality and all that. And so I tell them, but for the next class, I want them to have listed down what asset they're going to be looking at. And then after we learn how to put trend lines on the charts, I ask them to take the asset they're looking at, draw their trend line, and email it to me so I can see if they did it correctly. Do you know what? I hardly get any. But the next week in class, I get 1 billion questions about it. But the fact is, if they want to check if they were drawing correct trend lines, if they're drawing them incorrectly and they don't check, because this is how traders are. They get lazy. They think they can come to class, not put any more effort into it, and go out and risk their money. And, my job is to make you learn to trade properly so that you can stay in the markets. And stop making emotional or irrational decisions. So unlike business owners who generally have a business plan in order to provide a strategic vision to employees and to stay focused on their primary line of business, most traders never take the time to create a business or a trading plan. There are already 1 million articles on the web about trading plans. But what separates this article or this class from the rest is I will show you how to create a trading plan in less than 10 minutes by answering a series of simple questions. So let's go and let's take a look at the 10 elements. 1, how many trades will you use to evaluate your performance? In most lines of business, time is the main driver for evaluating performance. Companies report on a quarterly basis to the street, which fundamental analysts then feverishly work through the data to access a company's future growth potential. Well, how long should you wait to evaluate your trading performance? Yearly? Monthly? Daily? The answer to this question is very simple. Base your evaluation period on the number of trades placed and not by the amount of time passed. So in other words, If you say, after every 5 trades, I'm going to sit down and analyze, I'm not going to make any more trades until I've written up the analysis of all of these trades, then that's what you do. If you say, I'm going to use Wednesdays from not trading, and I'm going to, whatever it is, you have to put your performance, you have to evaluate your performance, and you have to set this in a deadline date. Just like you have a company review of your behavior. You want your raise every year. You want your review on the time that's scheduled. Okay, time is irrelevant in the world of trading. Trading is one of the few areas in this realm where the space-time continuum have no relevance. It's just about the number of trades. So the best way to do it is just say, after every 5 trades, I won't make another trade until I've done all my evaluation. But how do you make yourself stick to them? So those of us that have been trading for some time know that the 1-year stellar trading performance can lead to a 2-month binge of destruction, which can easily eradicate everything you work for so hard to create. In 1982 and 1983, while I was trading agriculture, I made so much money I didn't know what to do with it. I mean, it was just running from everything I touched turned to gold. Guess what happened by 84? I was broke. Because at the end of 83, the markets changed and shift. I wasn't doing any analysis. My strategies weren't working as well. I didn't realize it until it was too late. Then I started chasing trades because I needed to get my profit back into my account. And then one day I had no money left. Why? Because I wasn't sitting back and doing my evaluations properly. I was shoving them under the rug. And then I let my emotions get in the market and I started chasing the trades. That's a bad performance. The way to address the tracking of your performance is to create a set number of trades that you will evaluate against key performance metrics, which we'll look at next. Okay. So what is the number of trades you will use in evaluating your trading activity? I'm asking you, write it down. 2, identify your key performance matrix. I use KISS. Keep it simple, stupid. I want to measure my trades by what? Well, number 1, how much profit I made. Number 2, how successful they were. In other words, if I entered the euro US dollar and I was expecting to make 22 pips and I only made 18 pips, even though I made profit, was that trade successful based on my plan? And why wasn't it? Why did I set my target point at 22 points and I only made 18 points? So let's talk about R. This is the ratio of your profitable trades divided by your losing trades. Over a 10-trade cycle, I would take, for example, $15,000 in winners minus $5,000 in losers, which would equal R of 3. This makes it pretty easy to do the evaluation. The essential translates the fact that I profit 3 times more than I lose. You will want to measure R over every cycle. There is no set minimum or maximum R value. However, you'll want to track your performance over time and quickly identify when you are below your historical average. Now your maximum drawdown is next. This is the lowest intraday value that you will allow your account to get to. Okay. Most maximum drawdowns require a new high to take place in order to mark the drawdown. I, however, feel that this is not the right approach because it could take you a series of trading cycles before you hit a new portfolio high. This is not profit and loss ratio. If you have 3 active trades, those values of your trades have a value in your portfolio, and they're going up and down. Okay. You have to set what you're because that means if you have 1 trade going up and 3 trades going down, you need to sit back. You maybe need to withdraw yourself from the market for a little while. I recommend you determine how low your account has gone from your starting point of the cycle in percentage terms. For example, if I started trading or started a trading portfolio with $100,000 for a 10 sprint cycle and my account value hits $80,000, then my max drawdown was 20%. Just like R, there is no hard, fast rule on maximum drawdowns. It all depends on your money management skills, your money management, your risk management, and how much you can afford. I mean, this is depending on where you sit financially. Over time, you should aim to reduce your drawdowns. You should always be trading in the positive. as this is the ultimate lead to a portfolio balance that continues pointing up and to the left with very little pullback. 3, what time of day will you trade? For my day traders, I highly recommend you limit your trading activity. For me, I trade from 9:50 a.m. to 12 p.m. That's it. That's a 2-hour and 10-minute cycle. Any trading activity occurring before this or after this, I am purely a spectator on the sidelines. Sometimes you might see a very good trade, but it doesn't fit your plan. You put it aside. Similar to times of day trade, you keeping your trading edge down to 1 or 2 setups when starting out. The more strategy you hope to master, the more difficult it will become to consistently make money. So, below are the details of my trading edge. Early range breakouts, high volume, tight spreads, consolidation before a breakout. Only enter the market between 9:50 and 10:10. That's it. And if you feel like your list is bubbling up to 20 plus criteria, you will drive yourself crazy trying to restrict all your rules. You don't want to lock them in. Develop your standard methodology for identifying plays. For whoever keeps asking me what time of day it doesn't matter. If I trade from 9:50 to 10:10 my time, it's got absolutely nothing to do with you. You trade based on your time. This is not a rule I'm telling you to follow. This is my rule for me. You decide what time of day, how many hours you want to trade. Build your own trade. What time of zone I'm trading on is unimportant. Okay. You decide what is the dead zone. This had nothing to do with market dead zone or live zone. Maybe I work from 2 o'clock in the afternoon until 10 o'clock at night. So I trade 9:50 to 10:10. You decide what is your schedule. You decide when you're going to make the trade. You don't follow somebody else's trading plan. You build your own trading plan. Okay. Day traders will want to focus on events in the news, while long-term traders will want to focus on securities that are developing new growth and development. For day traders, you want to focus on the market movers. This provides you the greatest opportunity for locating stocks that are trending hard and with high liquidity. Now, goals are very important, short-term goals, to make consistent profits each month and supplement the monthly income from my job. To be patient and a disciplined trader who follows my plan. Now, that's an important key matrix factor. How many times did you deviate from your plan this month? Okay. Now, if you say only 1, that's not so bad. But then you should say, I want to try 0. Now, long-term trading goals. To build my trading account up to $25,000. You have to set your goals. I can't set your goals. These are just the areas in which you need to look at. You need to decide what fits you. Okay. You guys want to follow rules. Now, the thing is, this is what happens with trading strategies. Okay, forget tonight's class. You guys don't want to learn the basics of Bollinger Bands. You don't want to learn what the Bollinger Band percent indicator is and then build it yourself and test it yourself and build your own strategy. You want somebody to tell you what their strategy is so you can follow it. But the fact is, you can never get in somebody's side of their head. So if somebody's online or they're telling you, here's the strategy, and when this happens, do that and make that trade, you'll lose your money. Because they're not telling you all the fine little points. The reason you build your trading plan and the reason you learn the basics, the foundation of Bollinger Bands and the Bollinger Bands percent line is so that you can test it and test it and test it. So you write your own rules and you build your own trading strategy. And you know when it works and when it doesn't work. Okay. Trading in the markets require effort. It's just like when you learn to drive a car. Okay, you could read the manuals, you could take the written test, but you still have to get in that car and drive. Okay, and you have to learn how to drive. You have to learn how to upshift and downshift back in a manual car. You had to learn how to stop lights. You learned how to adjust. And eventually your foot knew how to touch the gas. And even when you get a new car, it takes you, a day to get adjusted to where the new shift are, to where the new blinkers are, to where, how hard you have to press. This is what you have to do, whether it's a trading plan or a strategy. If you start just wanting to tell people to do, what you'd end up doing is be the guy who can pass the driving test, the written part of the test, but when he goes and takes the driving, actual physical drive, he fails because he hasn't moved it from, he wants to drive by this set of rules, but when the reality of driving isn't those set of rules, you've never built that foundation. A trading plan will help you stay your course. And that's why it's the important first thing you do. But it helps you learn to put the effort into learning, analyzing, and filling out information as opposed to the satisfaction of making a trade. The high of making the trade and making profit gets addictive. Okay. If you can learn how to put the enjoyment into doing the analysis and making the decision, and the reward you get is that successful trade, it makes the whole process long. In other words, you've drawn something out that you now spent 8 hours instead of 10 minutes. So the ultimate reward is much better. Okay. A goal without a plan is just a wish. Now, we want to analyze the market conditions, which is important. Is the market trending or consolidating? You need to first determine what condition the market is in, because you can't employ a strategy unless you know, do we have a volatile market? Do we have a big market that's sitting back waiting for an economic event? Do we have something happening in the market? The market's hard trending. Like if we're looking at trading, say the S&P and the Dow, they've been in a hard uptrend. Okay. Then once you've analyzed the current market situation, then you can start pulling out your trading strategy to fit that type of current market. Maybe we have an extremely volatile market. Maybe we're in a risk-off market or we're in a risk-on market. Now what are we in? We're in summer season. That's a whole different set of trading analysis. We're in summer season. That means low volume, people on vacation, people parking money while they're on vacation. You have holiday seasons. You have election season. You have all kinds of different types of things that you have to analyze, not the current currency, the current state of the markets. Okay. What was the state of the markets last week? We had the whole global market for the week waiting for the Federal Reserve and the French elections. So if you were trading anything in the Eurozone, they were tied to French elections. Everybody in the U.S. was waiting for the Fed. So you had Dow, the S&P, gold, all of that holding back for the Fed decision. So you should have, once you've made this market analysis, then you can then determine how and what you want to trade. So then you want to take and determine the current support and resistance levels of the current market situation. Once you've figured out the market situation, then you decide what assets you would want to trade in that current market. Then the next thing you want to do is look at the support and resistance levels of those assets on a chart. You want to set your chart, put your trend line on there, put your support and resistance levels. These are your foundations. This is not your trading strategy. This is your foundation. And in your trading plan, you need to look at a current chart to see where these crucial levels are. Then we want to look for price action signals that have formed at confluent levels in the market, making sure to trade only very obvious and confluent setups. So then we want to go into stop losses. Where do we place our stop loss? How much are we risk? So my stop loss is once the position goes against me by 2%. But again, your stop loss is based on what you can afford. Because then you have to look at the volatility of the market. Because maybe where you have to put your stop loss based on the current swing of the market and what that possible stop loss would total in dollars may be outside your risk management or maybe too high for what your portfolio is. So if you got gold and gold is swinging up and down in a volatile day, even though it's going to go up today, it's got this thing because there's all kinds of news headlines, speech going, it could drop down $25. Maybe you can't cover that swing of the market. So when you calculate where you got to put your stop loss and what your potential loss could be, maybe it's outside your risk management, or maybe it's outside of what you can afford. So you also have to then determine when you want to exit a trade. You've all heard the market wizards say, let your winners run. Well, once you figure out what that means, please let me know. I don't ever enter a trade without a take profit point. Okay. Whether the market is going far beyond what I have projected. Okay. I'm happy if I think gold's going to go up and I'm at 1275 and I enter that trade, I've already determined I'm going to take my profit at $1,300. Now, you have two choices. Number one, don't get greedy. If you said, I'm going to invest $1,000 at $1,300, I'm going to take my profit and get out of the market, you made $2,500. You should be a very happy camper. Now, you could say, I'm going to let it run, but you're not. But there are many other ways. Okay, you can say that as the asset moves up towards my target point, I'll move up my stop loss and keep moving my target point forward. That's a possibility. Okay. But you should have a clear exit strategy. You should have a clear process. If you're using movable stop losses, maybe that's what you should do. That once the asset moves, once gold moved from 1275 to 1290, you'll keep moving your stop loss closer. So even if the market starts swinging against you, you get stopped out in profit. So these are important things to know. And you've built these into your trading plan because otherwise you don't even know what to watch for. Your trading plan is very concise. You've all figured it all out. So you could just quickly look at the price of an asset and say, oh, okay, I need to move my stop loss up. I need to do this. Maybe I'm going to close out. For some reason, because you could say that even though I project gold to be at 1,300, if it doesn't break the 1285 level by noon today, I'm going to close my position anyway. Okay. This is part of your trading plan. For some reason, traders have fooled themselves into thinking that successful trading only boils down to the latest algorithm or technical indicator. This couldn't be the farthest thing from the truth. When you are trading, you may forget that there are human beings on the other end of a buy or sell transaction. This is a head-to-head competition to see who was right, the bulls or the bears. Part of the game of trading is not revealing your hand. The smart money will consistently force sharp moves up or down in order to throw up the little guy before the big moves. You are probably asking yourself, what does a positive attitude have to do with this? Well, everyone may have stop loss orders, technical indicators, charts, access to news. There are some traders who are able to translate all this information into a successful trading plan, or the end result, money. The success factor, my friend, begins and ends with a winning attitude. Think about it. When you see your stocks have a short hiccup in a current uptrend, is your first reaction to sell and lock in your profits? Or do you move your stop up so quickly that you are actually begging the market to make the bigger trigger to trigger the order? The winning trader will see the same price movement as you. However, he or she will not interpret this information negatively. They will see a slight pullback in an uptrend as a healthy price action and will comfortably watch the chart move without a negative emotion in their body. If you build your trading plan and follow my stick-to-itness attitude, you won't get upset with this because this is the way the markets move. Thrust and ease, thrust and ease, thrust and ease. If you also believe that only 5 out of 10 traders or 4 out of 10 traders are going to be successful, well, you don't care if you even have a trade that doesn't do what you thought it was going to do because it's just getting you closer to your profit goal. Back for many years after I lost all my money in the markets, I went into business. And the rule of thumb was out of every 10 sales calls, only one was be successful. So my rule of thumb was, I want to get through those 9. So if you tell me to get out of your office, I don't care. You know what? Because you just moved me closer to my number 10. Okay. So if you don't get your emotions involved and see things as positive, Don't get negative emotion. Don't get worrisome and lost and try to jump out of the markets. The ability to sit through these corrections does not mean they have a lack of money management principles. It just means they believe in the markets will go in their favor as long as the correction or counter moves do not damage the overall trend. Okay, so number 8, without money management, you will not stand a chance of making it in the business of trading. For me, the amount of money I use per trade largely depends on how well I am performing. If I'm going through a rough patch and my key performance indicators are down, then I use less money to minimize the damage to my accounts. However, for keeping it simple in this article, I only use 10% of my available day trading power per trade. For example, if I have $250,000 in cash, this would translate to $1 million in day trading buying power based on leverage. So I would use no more than $100,000 per trade. If I'm using 100 to 1 leverage, I've got a very small investment. I still have a big risk. Number 9, when to take a break, and this is very important. That's why I said don't trade every day. If you want to trade 2 days a week, 3 days a week, take a day off. Sometimes you need to take a week off. I wish I took 1984 off. This is something you will not see in other trading plans on the web. When will you take a break from trading? Sounds like a no-brainer, but you will be surprised how many traders I talk to that never take breaks. And I'm talking about planned breaks. Whether the trader has just had the best series of trades or an all-out massacre of their account, the vast majority of traders will just keep on placing trades day after day. I take a break after I have placed 100 trades. I will take a day off just to give myself time to relax and reflect on my trading activity. You'd be asking yourself, could I just take a break on the weekends or over federal holidays? Very true, but taking a self-imposed break goes back to discipline and exercising my control on the markets. While the market is always there, I don't always have to respond to her every move. So remember, keep calm and take a break. Now, number 10 is always have limit up and limit down orders. I keep talking about take loss and stop profits. Okay. Every trade you make should have these. The major exchanges and proprietary firms think in terms of limit up and limit down. This concept of curb-in was originally created after the 1987 crash. Okay. Their risk management rules will closely monitor how a trader is up or down for the day. Once a trader reaches a particular extreme based on their past performance, trading performance, this trader is not allowed to place any additional trades for the day. Why we do as traders not think in terms of limit up and down. For me, if I lose 2% of my trading capital at any point in the day, I need to exit all positions and go fishing. Conversely, if I make 7.5% of my trading portfolio in one day, it's time to go fishing. You need to monitor, because just because you're doing everything right doesn't mean the market's going to cooperate. Sometimes the markets go into crazy consolidation. Sometimes they go into craziness altogether with. If things start moving against you, maybe it's time just to close out your trades, walk away for the day, and take a break. If things start moving very positively for you, don't keep pushing profit. Don't get greedy. If you have 3 open trades and one did extremely well, you know what? And you made 12% on one trade, you have one that's up 2%, one that's down 1%, maybe close out your positions, take your profit, put it in the bank, and go out and enjoy the day. Okay? It's not a horrible thing. Back as a salesman, I close a deal for $1 million. I take the next day off. I made enough. Okay? So let's talk about it. But you should always have stop and limit orders. You should always have yourself covered at all times. Okay. Now, I gave you the sample trading plan. These are just guidelines that you can try to work from. These are not mine. These are ones I just found on the internet for you. Okay. But they're differences. You see the differences. They're completely different. But they're just a starting point to help you figure out where to start. And if anything, if any of you are trading with X90, their account manager will work with you and help evaluate your trading plans. Okay. So it's one of the reasons to have a good trading company or a good broker you're dealing with, because their account managers, shouldn't be giving you advice, but they can sure help you build a trading plan. Okay. They can say, maybe you should point that up, maybe you should add this, and maybe you should look at that. They'll understand and help you with the money management, risk management features. So trading with X90 will give you some benefits there, because they have personal hands-on assistance for you. But thank you very much for joining us tonight. And for any of you who are asking if this class has been recorded, every class from investing.com is always recorded. And you only need to use the link that you had to get into tonight's class to get to the recorded version after a day later. So thank you very much for joining us tonight. But just the same way you came to class tonight, tomorrow when you click on that link, it's going to take you to the recorded version. So thank you very, very much. Have a great trading week. And please, I know it doesn't sound like fun, but you'll find out once you start building these things, building your strategy, writing them up, building your trading plans, writing them up. When you actually build a whole trade and a whole plan and you actually see that it actually worked, you're going to get this reward and this glow in your insides, because now you didn't kind of guess. You're trying to move this stuff from gambling and guessing over to smart business. And this is how you do. You'll move it over to being a real businessman, investor, trader. Thank you very much. Have a great day. And thank you for considering X90, and thank you for being part of the investing.com family. Good night now.